Hey, what's up, stock compounders? Brad here. So Charlie Munger gave the Daily Journal annual meeting this morning. Okay, and of course, as always, Charlie dropped a ton of wisdom. I took 6 pages of notes, and I want to share my highlights with you guys and also drill these lessons into my own head. So here we go. The first question. I noticed that our company is using margin debt to purchase overseas securities, and the overseas security is not reported in the SEC filing. I actually noticed this recently as well, and I was curious about it. As a shareholder, am I entitled to know what overseas security we own on margin? Charlie Munger's response, no, absolutely not. The practice at Daily Journal and Berkshire is the same. We disclose what we have to disclose because we don't want people to know what we're buying and selling. Okay, because I guess it's possible they're still buying and they just don't want the price to move around unnecessarily. So next question. This is about China. In January, Jeff Gundlach was quoted, "China is uninvestable, in my opinion, at this point. I've never invested in China, long or short. Why is that? I don't trust the data. I don't trust the relationship between the United States and China anymore. I think that investments in China could be confiscated. I think there's a risk of that." And then he's asked, "Please explain why you feel differently." So Charlie responds to that. Only the future knows who's going to be right. But China is a big modern nation. It's got this huge population and this huge modernity that's come in the last 30 years. We invested some money in China because we could get more value in terms of the strength of the enterprise and the price of the security than we could get in the United States. Other people, including Sequoia, the leading venture capital firm in the United States, have made the same decision we have. But I'm sympathetic to Gundlach. If he's nervous, he doesn't have to join us. Different folks have different opinions. I feel about Russia the way he feels about China. I can't criticize Gundlach's point of view. I just reached a different conclusion. Okay, so it's really simple. In investing, we can say no to almost everything and still do very well. Okay, I think that's really what Charlie is communicating there. There's no pressure, right, to buy in China. There's so many other opportunities in the world. And this is related to, we'll get into a question he's asked about why Warren Buffett hasn't bought Alibaba yet. But Daily Journal has recently bet a large amount of its capital on Alibaba, and a foreign traded stock. It's also taken on additional $40 million in margin debt to make these investments. What makes you so sure that these investments won't lead to a substantial impairment of Daily Journal's equity capital? Charlie answers, of course, if you invest in marketable securities, you have a risk that they'll go down and you'll lose money instead of making money. No guarantees. But if you hold a depreciating currency, that's a loss of purchasing power, right? You're losing purchasing power by doing nothing, by sitting on cash. So it's opportunity cost here. It's really what Charlie's pointing out. On balance, we prefer the risks we have to those we're avoiding. And we don't mind a tiny little bit of margin debt. So Charlie sees the $40 million in margin debt that they're utilizing at Daily Journal as a little bit, right? Basically insignificant, it sounds like, the way he's talking about it. He's asked about the VIE structure for Alibaba. As a Daily Journal owner, do we own local shares of Alibaba? Does that actually give us legal ownership of that business, or do we have a variable interest? What do we actually own through Baba? The answer from Charlie, when you buy Alibaba, you do get a sort of a derivative, but assuming there's a reasonable honor among civilized nations, That risk doesn't seem all that big to me. We invested in China for a simple reason. We got more strength per dollar invested. In China, the companies we invest in are stronger relative to their competition and priced lower. That's why we're in China. So Charlie doesn't seem to think the VIE structure, the variable interest entity, kind of the indirect ownership in a sense, is a big risk. He just doesn't see that as a big risk. Question, do the political pressures from the Chinese government worry you? Answer from Charlie, the Chinese government is worrying all the capitalists in the world way more than it used to. Of course, we don't like that. We wish that China and the US got along better. If you stop and think about it, think of how massively stupid both China and the US have been to allow the existing tensions to arise. What bad is ever going to happen to China or the United States if we two are close, right? If we get along, if we make amends, if we play on good terms with each other. So Charlie on the US-China tensions. So this is the Warren Buffett question. Considering the fortune Berkshire made on your BYD suggestion, why doesn't Buffett buy Alibaba, right? Why doesn't Berkshire Hathaway own Alibaba? Answer, Warren, like many other intelligent people, likes to invest where he's personally comfortable. Okay, this gets back to the whole gun lock discussion. For some reason, I'm more comfortable with the Chinese than he is. That's a minor difference, Charlie points out. I have all kinds of places where I'm just like Warren. I have all kinds of things where I'm not comfortable, and I just don't go near them. I think an old guy is entitled to invest where he wants to invest. So pretty simple there. He also points out, I don't think Alibaba is as entrenched as something like Apple and Alphabet. I think the internet is going to be a very competitive place, even if you're a big internet retailer. So he's pointing out there, even though Alibaba is significantly cheaper, relative to Apple and Google, he doesn't think it's as entrenched. It has as big of a moat, as wide of a moat that a company like Apple or Google have. Crypto came up about 42 minutes into the conversation here. He says, I'm proud of the fact that I've avoided crypto. Okay. Now he points out, he makes a whole new comparison. Rat poison squared was, the way Munger used to frame crypto. Now it's like some venereal disease or something. I just regard it as beneath contempt. I wish it had been banned immediately, and I admire the Chinese for banning it. I think they were right, and we've been wrong to allow it. Okay, so Munger hasn't changed his position on crypto. Still a lot of disdain for it. Question, I wonder what your favorite story of Wretched Excess is from the last year. So I think from the last Daily Journal meeting, he's pointing out all this wretched excess in the markets. These bubble signals. So the latest, certainly the great short squeeze in GameStop was wretched excess. Certainly the Bitcoin thing is wretched excess. I would argue that venture capital is throwing too much money too fast. We have a stock market which some people use as a gambling parlor. I think that's probably an understatement. The wretched excess has bad consequences. I don't think this is something that's widely understood. In fact, I'm quite sure it isn't. The consequences of these extreme bubbles, what Jeremy Grantham is pointing to as a super bubble. He says you can argue that the wretched excesses of the 1920s gave the US the Great Depression, and the Great Depression gave us Hitler. Okay, so this is serious stuff. Charlie is quite concerned about the degree of wretched excess taking place in the markets today. He's asked, is value investing dead? Okay, this question seems to come up over and over at the Daily Journal meeting, at the Berkshire Hathaway meeting. What is investing, right? Charlie Munger points out the idea of getting more value than you pay for, okay? That's what investment is if you want to be successful. You have to be getting more value back than what you're putting out. Buffett called it, one bird for two in the bush, right? You're paying one bird today, hoping there's two birds in the bush when you want it back. So, it's everything in investing. You're paying less than what you expect to get back. That'll never be obsolete. That's just a timeless principle of intelligent investing. There has never been anything quite like what we're doing now. And we do know from what's happened in other nations, if you try and print too much money, it eventually causes terrible trouble. We're closer to terrible trouble than we've been in the past, but we may still be a long way off. So, it's hard to really sink one's teeth into anything tangible here. But pattern-wise, this hasn't ended well. When other countries have run these kinds of experiments, the quantitative easing and the just printing of money that we've done in the last, say, 10, 12 years. He's asked about diversification. The Mungers have Berkshire stock, Costco stock, Chinese stocks through Lilu, a little bit of Daily Journal stock, and a bunch of apartment houses. He's actually asked this question in reference to inflation. How does one invest in an environment of escalating inflation? And Charlie's response is, do I think this is a perfect kind of portfolio in a rising inflation environment? No. Do I think it's okay? Yes. I think the great lesson from the Mungers is you don't need all this damn diversification. You're lucky if you have 4 good assets. And Charlie certainly does have 4 good assets here in Berkshire, Costco, Lilu's fund, and Daily Journal. So you're lucky if you have 4 good assets. If you're trying to do better than average, you're lucky if you have 4 things to buy, right? If you have 4 intelligent opportunities to plow money into, Munger would consider you lucky. To ask for 20 is really asking for egg in your beer. Okay, and I hadn't heard that expression before. I presume that's not a good thing. I don't often see eggs mixed into beer. But 20 sounds like it might be asking for trouble. Very few people have enough brains to get 20 good investments. And perhaps Munger is referring here to circle of competence. It's hard for someone to know enough for 20 great opportunities to be within that circle. I don't like a bunch of addicted young males spending 40 hours a week playing games on the TV. Okay, he's asked here about, I think it's Activision Blizzard. Talked a little bit about the gaming industry. He thinks there's a lot of time wasted, lives wasted on gaming. Does not strike me as a good result for civilization to be having these young males with all this potential to be playing video games. I'll be very surprised if global warming is going to be as bad as people say it's going to be. The temperature of the Earth went up about 1 degree Celsius in about 200 years. A hell of a lot of coal and oil was burned for that, perhaps small rise in temperature. So, Charlie Munger's thoughts on global warming here. he's asked, about Microsoft, Apple, and Google. What are they going to look like in 30, 40, 50 years? Are they still going to be around? Are they still going to be strong? He's actually asked about this in relation to Coca-Cola. So the questioner asked, if you look 40 years ago at Coca-Cola, do you think some of these big tech companies are in that same kind of position where they're going to dominate, where they're going to be incredible businesses for a number of decades going forward? And I'm surprised Charlie Munger had a perspective on this, but he said, it's very hard for me to imagine Microsoft, Apple, Google to not be strong 50 years from now, really strong. But if you asked me when I was young, what was going to happen to the department stores, the newspapers, I would have said the same thing, right? I would have said, of course, I can't see a scenario when those incredible businesses kind of lose that market dominance. And of course, that's exactly what transpired. Most of the department stores, most of the newspapers have done terribly for their investors. A lot of them have gone bankrupt. So, the point here is it's very hard to predict how the world will change over a lifetime, even over a generation, right? So I think that's a really important thing to keep in mind. It's easy to look at Facebook, look at Google, look at Microsoft, think, of course these companies are going to be dominant because they are now, right? And because they seem to have such a hold on the market. I mean, they've really driven the S&P 500 over the last 20 years. So it's hard to see that changing. But of course, humans are wired that way, to think things are going to persist, that have persisted, that seem really strong now. But that's just not how history tends to unfold over the course of a generation or more. What makes capitalism work? I found this really interesting. What makes capitalism work? If you're an able-bodied young person and you refuse to work, you suffer a fair amount of agony. Okay, so there's that kind of drive. There's that looming fear of penalty, in a sense, suffering if you're not working, if you're not contributing to capitalism. It's because of that agony that the whole economic system works, which is kind of a bleak way to look at it, right? It's doesn't seem all that inspired or inspiring, but such is the system we have. If you take away all the hardship and say you can stay home and get more than you'd get if you came to work, it's quite disruptive to an economic system like ours. And of course, this is referring to kind of the handouts that people got to stay at home. We're starting to really feel the disruption that caused. If you're managing your own affairs, you're going to be pretty efficient because you're taking care of your own property. So this deals with what's called the principal agent problem. If you're working for somebody else, you care more about yourself than the company you're working for. Capitalism is efficient when the people making decisions are doing it about their own property, right? They're owners. They have skin in the game. And this reminds me of Chris Meyer just put out a blog post about one of his most important filters for deciding whether or not to invest in a company is, are the owners of the business, are the people running the show at the company owners, right? Do they have skin in the game? Are they owner operators? And that really tackles this problem of principal agency, right? If you're a hired gun and you're getting a salary, you're probably going to optimize the company to run in a way that funnels the most benefits to you, right, as the manager. And sometimes there can be perverse incentive structures that get designed into companies. So you've really got to watch out for that. And of course, it is far beyond just managers in a company. It works kind of in a capitalistic wide systemic level. The Daily Journal is a mini Berkshire. Okay, Charlie Munger's words. That really caught my attention because there are so many super investors. There are so many great investors who own Berkshire Hathaway, right? It's like a core piece of their portfolio. If you look at Dataroma, you can see that. But there's only one super investor in Dataroma who owns Daily Journal, okay? Even though it's a mini Berkshire Hathaway, and that's Guy Spear, okay? Matt Peterson also owns Daily Journal, and he actually just shared with me a video between him and Guy Spear about Daily Journal. So if you want to check that out, look through my recent tweets on Twitter at @bkellner, and you can see that video. I think that's through, it's not through YouTube. It's, what's the name of it? I don't remember, but check out my recent tweets for that. On passive investing, so he's asked about passive investing. We have a new bunch of emperors, okay, as a result of all of these flows into passive investing, into passive index investing. We have a new bunch of emperors, and they are the people who vote the shares in the index funds. Maybe we can make Larry Fink and the people at Vanguard Pope. Charlie Munger says we cannot understate the magnitude of this shift. All of a sudden, we've had this enormous transfer of voting power to these passive index funds. That is going to change the world. I don't know what the consequences are, but I predict it won't be good. Okay, so that's really something to pay attention to. And there's actually Bill Brewster recently did a podcast. I think it was with Michael Green. If you guys watch this, soon after I publish it, it's probably the most recent podcast from the Business Brew with Bill Brewster. But they get into this passive situation, this passive investing, and what it's doing to the markets. It's creating some really wonky kind of behavior. So it's definitely something to learn about, to understand how are the dynamics shifting as a result of all of these passive flows into the market. So he's asked, is cash a sensible idea? And the gist of the question was, if we think we're at these frothy levels in terms of where the market is, does it make sense to cash out and kind of sit on the sidelines and wait for some kind of a crash, wait for an opportunity to get back in at more attractive levels? And Charlie's response, in my whole adult life, I've never hoarded cash waiting for better conditions. Okay. And that, I think that speaks volumes. Okay. There's so many people who think they can time the market in terms of sitting in cash, waiting for some kind of a correction to get in at better prices. Charlie Munger clearly does not think he has the ability to do that. And as one of the best investors in the world, I think it's safe to say with Charlie Munger, that says a lot about the folly of a lot of these investors who are trying to do just this. I've just invested in the best thing I could find. Berkshire has cash because it just can't find anything it can stand buying. It just can't find anything that's reasonably priced at the size that it would need to be buying, right? Because it's Berkshire Hathaway. So that's why Berkshire has cash. But, you know, Charlie doesn't have cash because he can find things. You know, there's a lot more he can look at than what Berkshire Hathaway is limited to looking at because of how big it is. Yeah. So we're getting near the end. In terms of being worried, you know, cashing out, sitting on the sidelines, he says, you're worried about the right things. All of you worried about inflation and the future of the republic, the future of the U.S. There are things to be worried about there. But in terms of sitting out in cash, Charlie doesn't think that that is the answer. People are less happy about the state of affairs than they were when things were way tougher. Okay, so this is a fascinating point that Charlie Munger brings up. You know, the quality of life today versus 100 years ago, orders of magnitude better. Okay, Charlie points out when he was young, people would have 6 kids, okay, because 3 of them would inevitably pass away. They wouldn't make it. Okay, that is a gut-wrenching reality from only, you know, a century ago. So things are way better today. That's just one example. But people are less happy, even though things are way better. And there's a very simple explanation for that. The world is not driven by greed. It is driven by envy. Okay? So whatever the state is, whatever the status quo is, we're always going to look around and see people who are better off than us and think, why are they better off? You know, don't I deserve to be better off? And the envy engine just kicks into high gear. That's just, you know, it's how we're wired. But we can change that. Okay, we can consciously decide, you know, this isn't how I'm going to play this game, right? I'm going to focus on gratitude. You know, there's all different tools out there to move away from envy. And Charlie points out, you know, he says, I have conquered envy in my own life. I don't envy anybody. I don't give a damn what somebody else has. And that is a very powerful way to live. It's a very powerful place to be operating from. But other people are driven crazy by it. We have whole networks now that pour gasoline on the flames of envy, many to profit from that. It's pretty sick, but that's, you know, the more conscious we can be of this, the less victim I think we can fall to this in our own lives. And it's a weird thing that as our standard of living gets better and better, people are less and less satisfied. Okay, so try not to fall into that trap as much as possible. The secret to a happy life. So Charlie Munger reveals the secret to a happy life. Okay, and it's kind of a funny thing. He says, first, reasonable expectations. And if that's not doing it, lower your expectations. Okay? Because what is happiness if not your experience of reality compared to your expectations of reality? If you simply lower your expectations, well, you're going to be happier. So, I mean, it's a very practical response, very rational. And then this is a lovely note to leave on. There will never be any shortage of good people in the world. Okay? All you have to do is seek them out and get as many of them as possible into your life. Sounds simple enough. And keep the rest the hell out. Okay, there are a lot of negative people. There's a lot of people you just don't want to associate with. They're not going to make your life better. They're going to drag it down. So an incredible skill to develop in life is to identify who are the few people I really want to spend my time with, and who are the many people that just don't belong there, just have no place in my life. They don't make it better. So So many words of wisdom from Charlie Munger, 98 years old, okay? And this is really the product. His life is a product of being a continuous learning machine for, decade after decade for so many years, right? 98 years. It's incredible. So awesome stuff, guys. I'm so grateful for the opportunity to be alive at a time when, Charlie Munger is sharing this wisdom every year through daily journal meetings, also through Berkshire Hathaway meetings, of course. So I hope you all enjoyed that today. I hope you all had a chance to watch the annual meeting. And let me know in the comments what your highlights were. Okay, I didn't make it to every kind of incredible soundbite from Charlie Munger in this video. But let me know what were your big takeaways. I'm curious to hear from you. So thanks for watching, everyone, and I will see you all in the next one. Take care.